Hi subscribers, welcome back to yet another statistical trader video. If you're a first-time viewer and you don't know me, my name is Diamond. I'm a quantitative trader and a trading technology specialist. I work with market makers, hedge funds, and exchanges, both cryptocurrency and normal stock exchanges. And in this channel, I share a lot about the other side of the business, the side of the business that you don't get to see. I share a lot of technical information and a lot of tips, actually, how you can make your trading better. So I invite you to enjoy this video. And if you like it, I invite you to subscribe to the channel. All right, in this video, I want to talk to you about why an equal or symmetrical long-short trading strategies are way overrated. So let's go. Okay, so an equal or a symmetrical long-short strategy is something that most of us are familiar with. It's a strategy that treats both long signals and short signals in the same fashion. It's leveraged on both sides equally, and it's assuming that the market is going to behave more or less 50-50%, on the upside, both on the downside. So it's trying to leverage both upward movements and downward movements, and it takes both of these signals by using an inverted or a mirrored entry signal from the other side. So if it's a long, let's say, let's take the normal example, the go-to example of trading the moving average crossovers. If you're trading along when the moving averages cross from below to above, if you're entering alongside, a short signal would be the opposite of that. So when you're crossing from above down below. So this is a symmetrical strategy, and in most traders' minds, these strategies are actually the kind of go-to strategies just because they're taking advantage of both regimes in the market. And I'm here to tell you why that might be flawed thinking. So there's actually 4 reasons why I think this is a bad approach. Number one is, I don't know if you know it or if you don't, but when a stock price drops a certain percentage in a certain time, and that usually, I don't know the exact rule, but I believe it's like 3% in 5 minutes or maybe 5% in 15 minutes or something like that. If such a sudden drop happens, there's an SEC rule that gets enacted on that instrument, basically forbidding any additional shorting of that instrument until the end of the week, in some cases until the end of the month. What this means is that if you have an equally long-short model, you are immediately crippled on the short side. You cannot actually execute your short signals in live market conditions if something like that happens. So that's number one, why I think it's flawed. Number two is because of the market's upward tendency. So if you really step back and if you really think about it and if you really evaluate it, what happens is markets are usually upward moving around 70% of the time when compared to downward movements, which probably maybe are 30% of the time or less. I don't even take into consideration the stagnation periods here. So knowing that markets are more upward moving, and this might not be true for all of the markets, but just in general, if you're trading stocks and if you're trading a portfolio that's kind of balanced, you will usually see an upward tendency more than a downward tendency. So having this in mind, that's another argument why an equally balanced long versus short approach is not as logical. Why wouldn't you take a more advantage or limit your risk on the short side? Because that's basically statistically less likely to happen. So that's number 2 why I think it's flawed. Number 3 is actually additional to number 1, to the SEC rules against shorting. There's a lot of different regulatory actions that can be taken when sudden moves or unexpected events happen. Like, for example, if the index price drops too drastically, too fast, the whole exchange might get closed for a period of time or until the end of the day. And we have seen this happen a number of times in our very near history, actually. So this means that you are not able, again, like in the first case, execute your short strategies, and you are not able, worse than that, to cover your shorts if you need to. Number 4 is because drops in price are a lot more sudden. Just if you look back historically, again, if something drops in price, that drop is so much more volatile, so much more drastic than the rising in price, even before the drop or even after the drop. Even take a look at the current COVID drop that we had in the markets in March. The drop was so sudden, it took probably like 5 or something days to really drop the market like 30% or probably more. The recovery process was very fast as well, but it was still slower. So having in mind that the drop is so much more volatile than the upward movement, your strategy might not be able to act fast enough, or you, if you're executing the strategy, might not be able to act fast enough if things really start happening. So that's number 4. And actually something that encompasses all of this that I really want you to think about is when you are building out your strategy, if you're doing backtesting, you might see on an equally or even not an equally long short model, on just a model that both does long and short, can be balanced differently, you might see your short signals in a backtest very profitable and performing very nicely, and you might think, oh, having a short side of the strategy actually, maybe reduces the drawdown curve or something like that, that you would actually act to add in the short side of the strategy into the whole logic. Problem with that is that if you are not thinking about these SEC regulations against short selling a stock, a movement that you historically see happening that gives you a nice piece of profits in the backtest, you might not be able to carry it out in actual live market conditions just because of these regulations that you are probably not thinking about at the time of backtesting. So this is something very important that I want you to really consider. By now you probably know that when I talk about backtesting, I really encourage you to think about everything, including things like these, like the unknown rules. So having this in mind, if you can't really properly test it out, you might be inclined to sustain from adding the short side of the strategy to your strategy. So next time you're building out a strategy, maybe consider a different approach for the short side, or maybe just consider ignoring the short selling altogether on your strategy. Thank you so much for watching this video. I do hope that it was informative for you. If you like the content, please give me the thumbs up, because that really helps me as a growing channel, but it also helps you because the YouTube algorithm will then promote better content that is more relevant to you. So win-win. So yes, thank you so much for watching. Please subscribe if you like the content. Don't subscribe if you don't, and see you in the next video. Bye.